Trading can make money. It is an exciting journey filled with potential. It is filled with opportunity.
But trading can also lose money. Many new traders push that reality to the back of their minds. They are drawn to quick profits. They are drawn to charts that promise a fast track to wealth. They are drawn to the stories of those who made it big. They focus so intently on potential gain that they forget the possibility of loss. This is the single biggest mistake a new trader can make. Risk, the chance a trade will move against you and diminish your capital, is real. Risk is an unavoidable part of this business. Lose too much, too quickly, and you're forced to leave the game before you learn. Good risk rules are not about preventing losses. They are about surviving losses. So, what is this concept of risk management? At its core, risk management is a set of rules you create to protect your trading capital. It is your financial shield. It is not a complex strategy designed to guarantee you win on every single trade. Winning every trade is an impossible fantasy. Instead, it is a practical defensive plan focused on controlling the size of your losses when you are wrong. A good plan ensures that your losing days are manageable and that your winning days have a meaningful positive impact on your account balance. This framework provides structure and removes the chaotic emotions that lead to disastrous trading decisions. Having a risk management plan makes trading less stressful. When you know the maximum amount you can possibly lose on any given trade before you enter it, you remove surprise and fear. You no longer have to sit glued to your screen, anxiously watching every tiny price movement, praying that a losing trade will turn around. Your plan is already in place. If the trade hits your predetermined loss limit, your plan executes automatically, and you exit with a small, controlled loss. The first and most important rule: risk only a tiny percentage of your total account on any single trade. This is your primary line of defense against a catastrophic loss. The most common guideline, the 1% rule. For any trade, set your position so the max you can lose is 1% of your trading capital. $2,000 account, 1% either $20. $10,000 account, 1% either $100. That number is your maximum acceptable loss. Imagine starting out. Your strategy isn't perfect. You hit a rough patch. 10 consecutive losing trades. If you risk 10% each trade, you'd wipe out your account. If you risk 1% each trade, after 10 losses, you've lost about 10% total. $2,000 drops to about $800. That's a survivable drawdown. You can keep trading and learning. The lure to get rich quick is powerful. Traders see a perfect setup and risk 20%, or even 50%, thinking, this is the one. But no trade is guaranteed. The market will do the unexpected. The 1% rule acts like a governor on emotion, prevents one dumb decision wiping out months of work. It keeps you grounded, focused on consistent, repeatable actions. If the 1% rule tells you how much you can risk in dollars, the stop loss is the tool that actually enforces that limit. A stop loss order is a preset instruction you give your broker to automatically close your trade at a specific price. If you buy a stock at $50, you might place a stop loss order at $48. If the price drops to $48, your broker automatically sells your position, limiting your loss to $2 per share. This order is your safety net, catching you before you fall too far. Using a stop loss is not optional. It is a mandatory part of every single trade. Many new traders resist using them. They think, the price will come back. I don't want to take a small loss only to see it reverse. This kind of thinking is rooted in hope, and hope is not a trading strategy. A small, defined loss is always better than an open-ended, potentially catastrophic one. A trade without a stop loss is a ticking time bomb. You are giving the market a blank check. Professionals never do this. They know their exit point before they enter. One destructive mistake is moving your stop loss further away to avoid a loss. Your stop is at 48. Price hits 48.10. In a panic, you move it to 47. A planned $2 loss becomes 10. Your stop loss should be sacred. Once set from your pre-trade analysis, never move it further away. Now we connect the pieces. You know you want to risk only 1% of your account. and you know you need to use a stop loss to enforce it. The next question is, how many shares or contracts should you buy or sell? This is called position sizing, and it ensures your risk is exactly your chosen percent, regardless of where your stop is. Many beginners overlook this. It's not just buy fewer shares. It's a calculation every time. Position size equals total account value times risk percentage divided by entry price minus stop loss price. Let's simplify it. First, 1% of 2,000 is $20. Second, the distance from entry to stop is $2. Finally, divide. 20 by 2 equals 10. Your correct position size is 10 shares. If stopped, you lose exactly $20. Perfect adherence to your rule. Wider stops demand fewer shares to keep dollar risk constant. Position sizing adjusts automatically. Section 6. Playing the odds. Understanding risk to reward. The risk-to-reward ratio is a simple comparison between the money you risk and the money you expect to make if the trade wins. Use it to filter for high-quality trades and avoid setups where potential profit isn't worth the risk. Risk 20 to aim for 60, that's 1 to 3, a good ratio. Even top traders are often right only 50 to 60% of the time. With 1 to 1 and 5 wins out of 10, you break even after gains and losses offset. With 1 to 2, 5 losses cost $100, 5 wins earn $200, net plus $100. That's the edge even at 50% accuracy. Before entering, define entry, stop loss, and a logical profit target like prior highs or resistance. If reward isn't at least twice risk, seriously consider passing. Patience compounds profitability. Section 7. The plan in action, a simple buy and sell example. Let's walk through these rules with a clear, numbered example. You have a $5,000 account. Choose 1% risk, $50, your anchor. Price is 25, strong support at 24, so place your stop just below at 23.50. Risk per share is $1.50. Position size equals 33 shares. You buy, total risk about $49.50, right on plan. For a short, ABC is 100, resistance 102, stop at 102.50. 250 risk per share yields 20 shares short. If stopped, you lose 50. Aim for at least 2 or 3 times your risk. XYZ target 29.50, ABC target 92.50, all planned before risking $1. This entire plan is made before you enter. Clarity first, execution second. Section 8. After the entry, how to manage a live trade. Your work is not done the moment you enter a trade. Manage to protect profits as they accumulate and give winners room to grow. A trailing stop moves with price. Up for longs, down for shorts, locking in gains. When XYZ hits 27, you can move stop to entry at 25. A risk-free trade. Move it too soon or too tight, and normal noise can stop you out. Use indicators or structure. Example, once price moves 1 R in your favor, move to break even. Avoid profit anxiety. Let a systematic trailing stop guide exits, not emotion. Define rules in advance, follow the procedure, and let winners run while protecting the downside. Section 9. Your simple path forward. A checklist to start today. Risk management isn't complex formulas or secret knowledge. It's simple, repeatable rules that protect capital and keep you in the game. The difference between those who thrive and those who fail is disciplined application. Risk management is the bedrock of your trading business. Remember these 3 rules. Risk a small fixed percent, preferably 1%. Always use a predetermined stop loss, and always calculate position size so your dollar risk aligns with your rule. Before every trade, confirm risk percent, place logical stop, calculate shares, check RR, AUK 1.2, write entry, stop, target in your journal. Take one step today. Calculate your 1% risk. Do a practice position size calculation. Control what you can control. Your risk. Start small, paper trade if needed, and trade with rules, not with hope.